45 years, zero name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
All right. So excited to convene in terms of our mortgage fund on another investor call. Just cannot believe that we are in 2026 and what, a quarter down. That is amazing. Time is flying by so fast. Something my father always told me, the older you get, the faster time flies, and certainly seems to be the case. My name is Patrick Prunty. I'm your fund manager. I operate out of our Newport office in Southern California. And, I'm the longest standing, most tenured Marshall Reddick team member. I'll be celebrating my 24th Marshall Reddick work anniversary in June. So about 2 months away. I can't even believe it. It's been a wild ride. It's been super fun. Had the luxury of working with a lot of you, existing capital partners, whether just in our direct lending program or now in our mortgage fund. Excited to meet those of you who are new, who are joining. And it's just, it's a dream come true to have the opportunity to work with everyone's capital, to help everyone earn a return, to do so safely, and to have the success that we've had. Again, just a dream come true. And I hope everyone appreciates the hard work that I and the team put in every day. This fund and our program certainly does not exist without the capital. So really big thank you to all of those who have been supporters of Marshall Reddick for so long. And those of you who are soon to be Marshall Reddick supporters or thinking about getting involved. So again, thanks to those existing capital partners. And of course, welcome to those who are new and maybe new to Marshall Reddick, but also maybe not new to Marshall Reddick, but new to our fund and interested in our mortgage fund and what it can offer. So excited to share those details with you in this session. Specifically, however, a lot of folks might already be familiar, but some aren't. What is Marshall Reddick Mortgage Fund? Okay, this is simply just a private investment fund, but specifically, it's a debt fund. There are many types of funds out there. Ours specifically invests in debt. And more specifically, our fund strictly invests, it's very niche. It's got to be non-owner occupied. First lien, of course, performing, and it's got to have a good collateral asset behind it. I don't like unsecured lending. People do crazy things when money's involved, and you always want to have that nice collateral asset there in the event of default. Because let's face it, lending money, it's an investment, there's a risk. The risk is low, it's calculated, it's consistent, it's predictable, it's safe, whatever you want to call it, but there is still risk. And if we've got that collateral property behind the scenes there as our safety in the event of not only borrower default, but it also could be construction cost overruns. It could be other economic factors that are out there. So being able to rely on that tangible real estate, especially residential, that's specifically something that we target as well. We don't do any type of commercial lending when it comes to the asset. So no medical, no office, no industrial, nothing like that. And we absolutely love single family homes. So this really is just kind of a snapshot about what our fund does. It does one thing. It does one thing really well. It's never going to earn you a 20 or 25% return, but you're also never going to lose money either. Our fund is open-ended, very important in the way we strategically designed it. With that in mind, we are always taking in capital and we are always returning capital. There is no end to the operation. It works in perpetuity. We are just constantly managing the money, investing it into performing first lien debt, collecting those monthly payments, portfolioing all of our loans, right? A lot of lenders that are out there, they originate the loan and they sell the loan. We do not do that. We originate the loan and we hold the loan. We collect the interest payments until term. We collect the payoff. And I think that's great. And I think that's great because we look at underwriting a little bit differently. We have to be comfortable with the asset and owning the asset. And that's like the best part about hard money lending, in my opinion, which is basically what we do. It's that it's collateral based. And it's like, if I have to own that property that I'm lending against, I'm good with that. It's like buying real estate at a discount. Hopefully I never have to take the property, and hopefully our default rate is going to be low as it has been historically. I don't see why that would change, but nonetheless, it's the fact that we have the collateral, right? And we don't mind owning it if we have to. In terms of the cash management and the investment management of this fund, it's very measured, it's methodical, it's conservative. That's who we are at Marshall Reddick. We need to be able to meet our obligations. We need to be able to operate successfully, and we need to do so in any economic, political, and other environment. And let's be honest here, economic environments change, political environments change. There's lots of factors that are going into all of these different landscapes that are out there that can affect things. But I think as long as we are conservative and we are methodical and we don't have style shift and deviate away from our purpose, our strategy, our goals, we're going to continue to have the success that we have as our overall hard money lending program, now 16 years in the works, and our fund here, which is now more than 6 years old. So to speak a little bit to that methodical and measured route and the fact that we're always taking in capital and returning capital, and you need to be able to exit too. So when I say return capital, that just means redeeming or taking your capital out for other ventures, other homes that you may want to buy, or other investments that you want to undertake, or maybe it's for retirement. Whatever that you need the capital for and you need to take it out, there is a path to do that. And liquidity is really good. I'm going to speak to that because that's something that's become very important to me as I've matured in my career with Marshall Reddick. So again, just like to show total investor capital by quarter, and this is net. So this factors in not only new incoming capital, but also the return of capital to investors who have previously invested and now need to take it out for whatever that reason may be. And this isn't our first rodeo. So as I mentioned, more than 6 years, and quarter one of this year was our 25th operational quarter. It's been a super fun learning experience, and to have the success that we've had, again, couldn't be happier. The goal when we started this fund was to raise 100 million, and to do so with a quarterly distribution, a quarterly profit distribution every single quarter without fail, and we have done that. So we're going to continue to do what has helped us be so successful. Bottom line here, folks, is that it's always a good time to invest. Folks are always asking me, like, should I do it now? Should I wait? Timing the market is not a thing with debt, right? We don't own the asset. So as long as we're lending at a good loan to value, values can go up and down, but our debt amount is much lower than the value of the asset. And also, we are a very short-term lender. We're not making 5, 10, 15, 30-year loans. We're making 6 and 12-month loans. And so, certainly economics and values can change quickly, but we're having the maturities and a need for the owner to pay off their loan via refinance or sale much quicker than a lot of times that those economic or political or other factors can have an effect, at least too much, on value. So there's never a bad time. It's always a good time to invest. And because we're so hyper-focused on short-term lending, liquidity is very high. So you can always redeem when needed. We certainly have operational paperwork for this fund. That paperwork would tell you that you need to give us 90 days to redeem your position. We are returning capital much faster than that, oftentimes 30 to 45 days. That's been our average in the 6 years that we've been operating this fund. So liquidity is only getting better. Certainly, you know, our goal is to keep 100% of the capital out, invested, earning. That helps us drive yield. But after running this fund for so long and seeing the portfolio grow, it's getting close to 300 loans in the portfolio. That's translating into payoffs every single day. And those payoffs are our liquidity. That's how we're able to originate new loans regularly. That's how we're able to release construction draws regularly. That is how we are able to redeem capital partners who desire to exit. And we're able to do this again slowly, methodically, safely. We've gotten really good at what we do. Our purpose in this fund hasn't changed. Certainly yields have gone up and down over the last 6 years, and interest rates remain high, but our goal was always to provide an 8% annual investor return. That's a net of expenses. That's inclusive of the preferred return and the profit split. And we want to do that at 2% per quarter. And we want to do it with super low risk. We just never want to miss the mark. And again, really excited after 25 quarters that we've been in that range on a quarterly basis. Of course, if we're doing that, it's rolling up to that 8% per annum. What are actually the returns, right? Well, it's an 8.47% since inception. If you had been an investor early on, like I was, in fact, I was the first investor in Marshall Reddick Mortgage Fund. And today I have continued to grow my position. I am certainly not the largest capital investor, but I am one of the largest capital investors in our fund. So I am a product of this 8.47%. This is if you are reinvesting your returns. That's a growth model as opposed to a cash flow model where you maybe are taking your quarterly earnings. You have the option to do either. I've chosen to reinvest mine from day one, take advantage of that compounding. So that is that 8.47%. We like to show it in 1, 3, and 5 year, as you would find with most investments and syndications and money managers. And so it certainly does fluctuate. It does go up and down based on a lot of different variables. I could never hope to explain all of those variables in one of these settings. But again, super excited and happy with the performance, and we expect these returns to continue. We've created a site, and we're going to have some exciting improvements coming to that site too. But you can visit this site and stay up to date on many metrics of this fund on an ongoing daily basis. We certainly are distributing our profit and loss and a lot of other key metrics on a quarterly basis as we shut down our fund every quarter and close out and distribute 100% of the net income. But you should stay in touch. And one of the coolest things about this site is what you see here on the right is this map of the United States. This was taken earlier today from that site. This is takes no manual update, right? This is updated based on the flow of loans on our mortgage page. And this represents really just the diversification by state of our portfolio of those loans. So when you see that number 41 in the state of Texas, we have 41 loans as of today as a part of our, I think it was 283. If you were to add up all of these across all the states, 283 loans in the portfolio today. Again, that number changing every single day as we originate new loans and we receive payoffs of prior loans. But we are, while diversified, we focus in a couple of core states, right? Texas has always been a big one for us. We've got several offices there for our property management and our brokerage business. We also focus heavily on Tennessee, but you'll notice that we've doubled down on Indiana and Ohio. Really, really solid growing markets that just haven't experienced some of the sort of negative trajectory that some states have. Certainly Florida is one that we have been, I won't use the word fleeing, but we've been very cautious of. Florida is one of those states. I don't know if by metric it is the state with the largest depreciation that has been experienced since the interest rate run up in 2022, but it is definitely down Whereas again, Indiana, Ohio, really just on a continual gradual upward, very inexpensive place to live. The cost of living very low. There's a lot of young people flocking to those areas. There's a lot of tech businesses in those areas. And so that is where a lot of investment is happening, a lot of fixing, a lot of flipping, a lot of buying, fixing, and refinancing, a lot of new construction going. So those are not new markets to us. We've been investing in those since our private lending program started back in 2010. But again, a lot of really helpful information on this, including capital returns, our structure, which our structure is going to change soon. I'll be speaking to that. Our operating documents. So if you ever want to get into the PPM, which is like a prospectus for a private investment fund like ours, or the subscription agreement, if you want to review that, that's the document that every investor signs when they choose to put in a new investment capital into this fund. You can certainly see the portfolio holdings and get more granular than just the number by state. You can get into the actual loans that are those 41 in Texas or those 64 in Indiana. And then of course we publish and show the world our quarterly operating history by quarter since inception. We're also showing the amount of capital that we have, the amount of loans, and you can again see that kind of like slow, methodical, just conservative growth that we've had that just makes us feel good day in and day out. So some of the things I'd like to speak to, existing investors, prospective investors, got a good mix of both on the call. What's new, some really cool things I'm excited to share. And then of course, what's not new. Because a lot of times, people are looking at us and saying, that is just a non-sexy fund. And I say, you know what, but I just like making money every single quarter. Okay, so to our existing investors, right? Do not forget about your investor portal. Certainly, we love to talk to you, and you're welcome to reach out to us. But we're getting a lot of questions that are answered inside that investor portal. It's just that online resource for you to be able to log in to see your quarterly statements, to see your transaction history. You can connect bank accounts in that portal safely, where you can invest more money, and we can certainly return your distributions, your earnings to you on a quarterly basis. There's a lot of other cool things in that investor portal. Otherwise, the best and fastest way to get to us, whether that is investing new money, whether that is withdrawing money, whether that is changing your election to reinvest or take the quarterly earnings, any question that you have, it should be directed at MRMF, which stands for Marshall Reddick Mortgage Fund, at marshallreddick.com. That is a group and a highly monitored email inbox by a lot of accounting folks, a lot of folks that work on my team. I am only one person, and I would love to speak to everybody, and I would get to you. It's just there are so many of you now. We now have north of 350 capital partners in this fund, and that doesn't even include our direct lending capital. So this is the best and fastest way to get there as an existing investor. QR code. So if you forget, I have so many people asking, saying, what's that URL? What's the website to log into that portal? Well, here you go. You can scan this on your mobile phone, and it would take you. That URL is also right here. You can also find that on our website. When you hit the login button, you get 4 choices, and the bottom choice is the investment fund. You can also download the mobile app. A lot of people are doing business and are reviewing things on the fly as technology expands. So the software provider that we use is Appfolio, and they have created a mobile app where you can log into your investor portal, and you can do everything there in a mobile-friendly version that you can on a desktop version or a laptop version. This QR code will take you to your app store where you can download that mobile app. Year-end tax documentation, just a house cleaning item here, right? Well, everybody that's an investor in our fund, you have a K-1 that has been poured over and has been calculated up, down, left, right, sideways. It is now available in the tax form tab of the investor portal. Grab it there. They are not mailed. They are only available digitally for download in the investor portal. Okay, moving on to our prospective investors. You need to speak to Vince Tomich. Vince is, like myself, a long tenured staff member of Marshall Reddick. He works technically on our brokerage team, but he is more versed in our mortgage fund and has been a capital investor in our mortgage fund as long as I have, since day one. So Vince is extremely knowledgeable. He is like our fund consultant. There are other folks on our team that are fund consultants, and if you're already been talking with and assigned to somebody else, that is totally fine. But if you don't know anything and you need to speak to someone, or you want to set something up and you want to learn more than I can share with you on this investor call, Vince is your guy. QR code here if you prefer not to reach out directly to Vince, but you want to schedule a consultation, you can do so on our website. This would be more round robin, who is going to get to that first, but somebody will contact you and they will set up that consultation. You are welcome to come to our office here in Newport. We would love to host you for coffee. We have fun events all the time. You should be on that mailing list and you should come to our fun events. About a year ago, we did some at Fleming's here in Orange County, and we did one in LA. Super fun. Get to mingle with everybody and meet other capital partners like yourself and get to meet staff of our team. So get to know Marshall Reddick. We certainly want to get to know you. So what is new? And I'm just so happy to have completed our first financial statement audit. I had no idea what this was going to entail. I was not scared because we do our accounting and we do all of our management extremely well. Our documentation is in great order. That's both on the borrower side and on the investor side. But again, what the fear is of the unknown, but we flew through this financial statement audit. This is a self-induced audit. This is an extremely positive experience. But we completed that. We also have now formalized our loss reserve allocation, and that is something that came out of that audit. I'll speak to both of those things. Here is the screen clip of what that audit letter looks like. It's very detailed. I really encourage you to read it. I am extremely proud of it. I'm extremely proud of the glowing results and opinion that we received from Armanino, who is our auditing firm. They are not the largest, but they are certainly not the smallest. I suspect they are in the top 10 when it comes to like global accountancy firms. They know what they're doing. They specialize in debt funds, just like ours. So this was completed over like a 6-month period. We were highly active and engaged with the Armanino audit team between like November, December, January, and February. It was a long process. It was a very invasive process. That 15-page opinion is posted on that site that I talked to you guys about and is available for download to the public, along with our Q1 2026 investor letter that I publish and release every single quarter. When you're on that page, if you scroll down to the historical performance section, you will find what you see on the screen here. You want to click on that MRMF Q1 2026 investor letter. That's where we will post our financials every quarter. That is here where I have posted, excuse me, that audit opinion letter, and you should dive into it. It is awesome. Also, as a part of that, I mentioned the formalization of our loss reserve. This was required by the financial statement audit. What this is us expensing on a monthly basis an allocation of potential expected loan losses, right? I would love to bat 1,000, but that's not possible. When you lend money, there will be losses, but that is part of lending money. The percentage of loans that go into default and that experience losses is very minor. That reason mainly for that is loan to value and underwriting, which we've gotten extremely good at. But nonetheless, we still, as a part of an audited debt fund, we are required to allocate money into a loss reserve. This is something that banks have to do. It's a safety mechanism. It avoids super large volatility in the quarterly returns that we are distributing. And that again is a safety mechanism to all of the capital partners. This allocation is formalized via what they call a current expected credit loss model. This was I won't say an eye-opening experience, but it really, really forced me and the loan committee to pour over our loan tape. I mean, painstakingly by line, which was an excellent experience. It's also forced us to really look into how to automate a lot of this and to improve our software, because this took a significant amount of time. The current expected credit loss model looks like this. It's in the form of a memo. It's about 8 pages long. It really speaks to the mega underlying details of our loan tape and our portfolio. We have to do this as an audited debt fund at a minimum of once per year. We can do it more often, but once a year is proven sufficient at this time. Again, it gives great insight to our fund, and it's based on 3 major factors. This is our historical loan losses. What losses have we experienced in our 6-year operating period? What is in our current portfolio? Do we have landmines in our existing portfolio, and should we be putting more money in our loss reserve to weather the storm of those landmines? We don't. But that's what it means here by our current portfolio data, which of course includes and points a lot and is based a lot on loan delinquency. So we had to just pull the wool, pull the shades up on everything that we had and show all of this to the auditors. And again, it was a super positive experience. And then the last thing, of course, that is taken into consideration in this model is the economic forecast. Again, a supportable economic forecast as it pertains specifically to us in residential real estate and the underlying debt segment that supports that residential real estate factor of overall macroeconomics. So if you would like a copy of this, please send a request to Investor Relations, again, at mrmf@marshallreddick.com. I would be happy to send it to you. We have a lot of engineers and scientists that are capital partners in our fund, and they like to do data science on our portfolio and get super granular. I'm totally on board for that. It's all about the transparency that we offer here in this fund. And it's like, look, again, we do one thing really well, and we have no problem showing all of the nitty-gritty details to anyone who is interested and would like to look at it. What's not new? Well, we're distributing profits again, 25th quarter in a row. 1.78 million net. That is after all expenses, before profit split, and that is just from the operations of quarter 1. Our portfolio is super strong and well diversified. Nothing new there. Nothing has changed. It has been the same since day 1. Lots of experienced and repeat borrowers, many of which, the lion's share of which, are making timely, regular monthly payments. And we are all backed by solid loan to value secured against residential collateral assets that we wouldn't mind owning. So again, these are kind of just the basics. Business as usual in Q1. Revenue over 2 million and continues an upward trajectory there from Q4. Operating expense, it's up a little bit. The audit was not cheap. We also have had to formalize our loss reserve. So now we don't have, hey, this is how I'm feeling about my loss reserve, and have some flexibility of the contribution to that loss reserve. Now it's based on a formula. Now I have to put a percentage of my loans receivable into that safety mechanism, if you will, on a monthly basis. And then, of course, just some other random income expenses. This is a lot of like interest earned on cash sitting idle in the bank, or potentially like state income taxes, the minimum state income taxes that we have to pay as an operating entity in California. As a California partnership, as we all know, though, and I am not a tax professional, I'm not a CPA, I'm not giving tax advice, but all of the tax is passed through to the capital partners via the K-1, and you pay your share of the partnership income tax at your individual level. Net income 1.78, as we've talked about, that is down a little bit from the prior quarter. There is reason for that, and there is no reason for concern for that. I have had some people ask me about potentially a downward trend in our yield, and I have a a reasonable explanation for that, and it all has to do with us transitioning into becoming an audited debt fund, with the next step being a REIT. I will speak to that as well. But loans receivable on an upward trajectory, that is great. That means that we have new capital coming in and we're continuing our slow, methodical upward trend. Total assets on an upward trajectory as well, as would be expected if loans receivable, which of course is our largest asset. Our other assets would be accounts receivable and cash in the bank. So that 1.78 million in net profit to be distributed represents 2.29% in the quarter for Q1 of the capital under management. That annualizes at 9.16, and this is after expenses but before profit split. Certainly, we are in business as a fund and the fund manager to make money. We're not able to do that unless we distributed the 6% preferred return to the capital partners. And then after the 6% preferred return, we have 3% or 3 profit split tiers that are based on capital account. This is also nothing new and has been in play for several years. The base tier is a 50% profit split after you get your preferred return. Of course, the back end of the profit split, the equal or lower percentage, is the percentage paid to management and is the income, is the business model that we are after. So we are not penalizing any capital partners by having lower capital account positions. We are taking more money from management and paying it to those with larger capital positions. It's much easier to manage less investors with more money than it is more investors with less money. As I mentioned, we've gotten up to 350 capital partners. We expect that to continue to go up. And as we get more of the management of those capital partners, and again, that's just one half of our business, right? Think about the 287 loans in the portfolio, and each of those have a borrower and of course an escrow and a title and a loan servicer and all these different parties that we've got to work with to make this happen. So again, Q1 was our 25th operational quarter. I've mentioned that, and we expect to continue for the next 25 quarters to maintain profitability and to release earnings and good solid profits in every quarter. That has been and always will be the goal. Diving in, okay, here's our P&L, right? Again, transparency. This is available with the quarterly investor letter. It's just the public can download it. If it's small here, I'm sorry you can't see it, but again, you can download it on your computer. You can print it out if you'd like. It's there for everyone to see. And to kind of just dive through that, I won't spend too much time here. I like to break down, though, those profit splits. And I do so first by taking the total net income there at the bottom of this P&L. And again, how does that break down? Well, lion's share preferred return, 1.145 million. That leaves 636,000 for the profits to be split. And again, it's based on your capital account. So we basically take a quarterly return, that's your 1.5, back out the 2.29% that we earned in the quarter, net of expenses, that leaves 0.79%. That would all be based on your capital account to be split. And this is all really easy calculator math where you can go in and calculate your own return based on your starting capital account with these percentages. How does that round up? Well, what happens is that you take your preferred return plus your profit split to get to your annualized number. Annualization here is just simply multiplying by 4. And keep in mind, of course, that every quarter is a little bit different, sometimes higher, sometimes lower, but all within tolerance, hovering around that 2% goal that we set out, that we structured with this fund. Here's our balance sheet. And there's been some changes here over the past couple of years as we've been preparing to become this audited fund, this audited debt fund. And so I like to point out, I get questioned about those changes, and those specifically are our allowance for expected loan losses. I've spoke to that. Also, I haven't spoken about what is a big deal is deferred loan fees. That number continues to rise. And that is a big deal and is the primary factor going into what you appear to visually see as a potential decline in yield. And it's just an accounting function, but I'll speak to that. And then lastly, it's our lender draws on hold. So we're approaching $15 million there. That number is a part of our total loans receivable on the top side of the balance sheet here, which is nearly 95 million. These are just funds that are pledged to the borrower. And these funds are not yet drawn upon. So let's talk about those three things, right? The expected loan losses, that's 512,000. That is 0.63% of investor capital at quarter turn, and these funds have been accumulating there over the past 6 years. That is a safety mechanism. If we have a loan that translates into a foreclosure or a short sale or something where we actually lose principal, that loss will be offset into this account on the balance sheet. It would not affect or be written down as an expense on the profit and loss statement. And moving on to the deferred loan fees. Again, it's an accumulation, 806,000. That is a big number as of April 1st, which is the start of the second quarter. This is simply loan fees that we have earned. We earn loan fees by making loans. We earn loan points, if you want to call that. And prior to becoming an audited fund, we were recognizing those loan fees, that percentage. We strive to earn 2% as the commission, or again, the loan fee, whatever you want to call it. We were recognizing those upfront at loan origination, all in one lump sum. As an audited debt fund, you cannot do that. You have to spread out that 2% over the life of the loan. So if it's a 12-month loan, that 2% is divided by 12 and brought in as revenue in a 1/12 increments until that loan pays off, at which point you would recognize the unearned portion all at once at loan payoff. If it's a 30-year loan, geez, I'm so glad we don't make those. But if it was, you would have to take that 2 or 3% loan origination fee and divide it by 360 months and bring in 1/360th every month until payoff. So that 806,000 that you see that on that balance sheet, those is all revenue that is yet to post to our P&L and is done on an ongoing basis. It's like taking those loan fees and packing them into the interest that we are receiving from the borrower on an ongoing monthly basis. Okay, lender draws on hold. I spoke to that a minute ago, right? This just represents an accumulated amount of capital borrowed for renovation and construction that has not yet been released. Right? This is a highly managed portion of our business. We have an entire funds control department now, and these funds are released when requested on a loan by loan basis. And the borrower must do the work first, show us evidence of such work before we release money. But our draw request swings are becoming significant when we have this kind of capital on hold. But this is also a yield enhancement mechanism. We're not earning interest on all 15 million, but a large portion of it we are. Banks do the same thing. Alrighty, speak to that deferred loan fees again. And we did an analysis here in this last quarter because we had a really, really good quarter in terms of loan origination. We had some large loans that went out. So in all reality, from the loan operations in Q1, we earned almost 610,000 in loan fees alone. We, however, on the P&L only recognized 353,000. That is a delta or an unrecognized 255,000. Had we done things the prior way, and again, we didn't just rip off the Band-Aid and start amortizing our loans in just this one quarter. We methodically started that process back in April of 2025, 1 year ago, amortizing a few more, a higher percentage of our loans on a monthly basis as we methodically prepared for this audit that we were about to undertake that happened over the last 2 quarters. But nonetheless, we are still experiencing that drag, if you want to call it that. Had we posted 609,000 and that difference of 255,000 to our P&L in this particular quarter, Our net of expenses earnings distribution would have been 2.62, which might be a record. I didn't match that up with all of our prior earnings, but it is very high. So there is no difference in operations. There is nothing happening behind the scenes. The fund is operating as intended and nearly perfectly. We expect the smooth out of the deferred loan fees to kind of get to a zero unrecognition sometime perhaps in Q3 of this year. So because of that, my forecast is that you should start to see a gradual increase in that yield where you've visually seen it sort of look as if it was trending downwards. It will all smooth out over time. Okay, so to speak to our portfolio being strong and well diversified, 287 loans as of the start of the quarter, loan to value staying under 65%. That is just an absolute must as a hard money lender. We love single family homes, as we mentioned. 85% of the capital is invested in them, very easily valued, very easily disposed of in the event of default, and we get into a short sale situation. 80% of the loans with that moving upward, that next quarter is going to be closer to 85%, are in loan terms of less than 12 months. That's one of the coolest metrics that came out of the audit. It's like it broke down our capital, our like $90 million that's out in loans by like maturity. So how much is maturing in less than 12 months and in 24 to 60 months and so on. You should check out those details. And then a really cool thing about our fund, especially compared to a lot of our competitors aren't as well diversified. They might be California only when it comes to the collateral assets they're lending against. And certainly we love California, our home state, but California over-levers the fund with very, very high loan amounts. And the fact that we're focused a lot in the Midwest and in the South helps us keep our average loan amount down. If one of these loans or a handful or even a dozen loans at this average loan amount go sideways, go into default, it just doesn't even move the needle in terms of the yield or in terms of like potential problems for the portfolio at the size that it is today, with the diversification of where it is and diversification by borrower, diversification by geographic location of the collateral asset. So again, here's that map. Again, I just love this, and I want to recommend that you go and check it out and click right on the numbers where you can get into the granularity of what actually those 47 or 64 or 11 loans are in that state that the fund owns that is in the portfolio. So don't take our word for it. That's why we did the audit. I've had so many people ask, like, why did you spend all this money on the audit? Why did you do it? What was the point of it? Well, there's a lot of reasons, but one of the reasons is that larger capital partners, as we have continued to mature in this fund, we are getting looks from larger capital partners, people that have the ability to write checks for $5 million, even larger than that, much larger than that. Now, we're gun shy of that, and we don't want to take on that because we don't want to have any single capital partner that's got too large of a percentage. That's in our mind too. But the audit is important because now, even though we're transparent and we're showing you everything, people know that an audit is super invasive. Auditors poured over our loan tape, loan by loan, and factoring the number of loans that we have, right? You're not just taking our word for it. What's the makeup of the portfolio? It breaks down it by single family home and land and multifamily and all these different asset classes inside of residential. It talks to our average loan. It speaks to our largest loan. It speaks to loan delinquency on a loan by loan basis. It speaks to the number of loans that we have actively in foreclosure. I mean, it is ultra detailed. They contacted our borrowers, right? They did a random selection and send out like 50 different like memos to borrowers that have loans out, fact checking what the unpaid principal balance was. They reviewed our collateral files. They wanted to see, like, did we actually record a deed of trust and a mortgage in the county where the property was located? Guess what? We did. They made us get third-party collateral valuations, not on every single one of the collateral assets that we lend on, but a random sampling of them. And guess what? The valuations were spot on with our internal underwriting. It felt so good to go through this, even though it was a mountain of work. They contacted our investors, same way they contacted our borrowers. 50 or 60 of our capital partners, you might have been one of them. They contacted you. They wanted you to confirm that the balance that we're showing on our balance sheet is the balance that you believe, that's on your statement, that's in your portal, that the earnings are being calculated correctly. I mean, it was amazing. They picked apart our financials. They picked apart our safety mechanisms, our checks and our balances. Something that's very rampant in our industry is wire fraud. So they wanted to talk about how many people touch those wire instructions, and that the person that's inputting the wire isn't the person that's releasing the wire. These are the reasons that we undertake this audit. So bottom line again, and I've said that before, but we're really pleased with the performance and the results of this fund. We expect the performance and the results of this fund to continue. And it just doesn't matter what the economic environment looks like, what the political environment looks like, what other landscape environment changes are happening out there. It's just not going to have an effect, at least a major effect, at a macro level on our fund with its diversity that it has, and given the loan to values and giving the security, the collateral that we have. So what's next? Well, we're going to continue our methodical march to 100 million, and then we're probably going beyond that. We're probably coming in with another fund too. Okay, we're going to end up with 2 funds, and I'll speak to why we're going to do that. But we're going to continue to post earnings between 8 and 10% per annum. That was our goal. 8 was always the baseline, but the increased tiers based on capital will help you get up into that 8.5, 9, 9.25, potentially, depending on how things go. We would love to hit that 10% for that 3 million and up top capital partner. And then we're going to do this REIT installation. And some people don't know exactly what that means, or it's like, why, right? Because again, this is a big, expensive undertaking, just like the audit. But the bottom line is that a real estate investment trust, it allows us to do a lot of things, but 2 really important things. It is going to save you on income taxes. The earnings that you are getting, unless you are investing with a self-directed retirement account, which you can certainly do, and maybe about 25% of the capital, about the $85 million that we have today invested, is from self-directed retirement accounts. That if you are not investing with a self-directed retirement account, you are paying income tax on your earnings, whether you are physically taking them or whether you're reinvesting them. You will save, again, not a CPA, but I believe that number is 20% in the terms of a qualified business income tax deduction. When we switch from a partnership to a REIT, you will no longer get a K1, you will get a 1099 DIV. That is a big deal, especially for larger capital partners who are paying more than their fair share, potentially, of income tax. And then, of course, we would be able to bring on leverage. We can borrow money secured against our assets, our loans, and the underlying collateral. And we would be able to do that inside of a real estate investment trust and avoid UBTI. That stands for unrelated business taxable income. If you don't know what that is, that's okay. If you are investing with a self-directed retirement account, then you know what that is, or you should know what that is. But we'd be able to bring on leverage as a real estate investment trust and block UBTI, so there'd be no effect to our self-directed retirement account investors. Again, that is a big deal. Now, let me speak to the leverage. We would never over-lever this fund, but as I mentioned, the cash flow management has many, many variables and is becoming a very difficult task without a short-term liquidity borrow ability. So I think a 10, a 15, perhaps even a 20% leverage credit facility would not only help us increase returns, would help us drive up our yield more to that 10% number, but it's also going to be able to help us be more aggressive in terms of origination, because we won't having to reserve cash for redemptions of people exiting, or for construction draws that need to be taken, or potential loan payoffs that didn't materialize. And of course, if I don't have that cash, then I can't meet my obligations in terms of new originations, or like I said, in terms of construction draw requests, or in terms of redeeming capital partners that need to redeem. So a lot of really positive things happening, and the REIT is going to be one of those next big things to happen now that we have completed our audit. So again, let's speak to the existing investors as we wind down here. Appreciate everyone's time on a Thursday. So investor relations, existing investors, right? If you have questions, this is the fastest way to get an answer. If you want to talk to somebody on the phone, that's great. We subscribe to that. We are not the company that is going to force you to do everything digitally, but you need to schedule time in this email as an existing partner, and then we will schedule time to speak with you and get your questions answered if they cannot be answered over email. We love referrals. That's how Marshall Reddick has grown our business, including this fund. So please, we would love for you to tell your family, friends, and colleagues about our fund, about what we do here. We would love to take great care of them and to help them earn like you have been earning. As to my prospective investors that are out there, right? These are just some of the things that are happening. You have idle cash. You're looking for a safe and liquid place to put it. You're rebalancing a current portfolio. Maybe you had money in CDs and other money market accounts, and of course, you're starting to see your yield come down. We would love to have you join as a capital partner in this fund, or replacing underperforming investments. It's very safe, it's low risk, it's consistent, it's predictable, it's backed by residential real estate and the Marshall Reddick track record, right? That is a big deal. So to my prospective investors, again, still, if you are not sure how to get started, book a consultation with Vince, request access to the fund portal. You have to be an accredited investor. That is the rule. If you're not sure what an accredited investor is, it's not a big deal. Most of you that are on here have found yourself that are spending time to improve your investment portfolio and to improve your finances and to become financially independent. I bet you are already an accredited investor, doing so either income or net worth, or potentially both, but it just needs to be one or the other. You sign paperwork, that's super easy. You deposit investment capital. You do that inside the portal, of course. That's the fastest and the safest way to do it. And then you start collecting, or if you're like me, going for the growth mechanism, you reinvest your earnings to your capital account. And I'm telling you, it just grows exponentially. Vince's contact information, again, don't be shy. I know he contacted everybody that had signed up for this. So you have a voicemail, you have a text, or maybe you got on the phone with Vince today. He's a great guy. I encourage you to stay in touch with him. And again, my name is Patrick Prunty, so I can't tell you how much I appreciate each and every one of you. To those existing capital partners who have been there with me from day one and who are going to continue to be with me as we continue this journey, thank you. To those investors that are out there that are thinking about doing it, I would love to speak with you. I would love for you to come to our office and see our operation. I would love to answer any questions that you have, but please, I'm only one person, right? Leverage my team, and if you need to get to me, I will make time for you. So I appreciate your time on our Q1 2026 investor call, and I look forward to having you on our next and every investor call that we will host every quarter at around this time after we've produced our results and you've gotten your earnings check. So again, thanks for joining this session and have a great rest of your day.